Are you still writing checks to the IRS for taxes you may not legally owe? If you're 60 or older and collecting Social Security, or getting ready to, there is a very real chance you are overpaying, not because you're doing anything wrong, but simply because nobody told you what changed. Stay with me through this entire video, because by the end, you'll know 5 specific tax areas where seniors like you may be able to stop paying, or pay significantly lesser starting right now in 2026. Welcome back, and if you're new here, welcome. This channel is dedicated to helping American retirees and near retirees navigate Social Security, Medicare, and retirement finances with clarity and confidence. Today's topic is one that generates a lot of anxiety, and honestly, a lot of confusion: taxes in retirement. Here's what most people don't realize: the US tax code actually contains a number of provisions specifically designed to reduce the tax burden on older Americans. We're talking about exemptions, deductions, credits, and relief programs that many seniors either don't know about or assume they don't qualify for. Now, I want to be clear with you right up front. Not every senior qualifies for every one of these. Your eligibility depends on things like your income level, your age, the state you live in, your filing status, and your personal circumstances. That's exactly why I'll walk through each one carefully, explaining who it applies to, how it works, and giving you a real-world example so it actually makes sense. There's no hype here. No, the government owes you money promises. Just honest, practical information so you can have a smarter conversation with your tax preparer or financial advisor. Let's get into it. Most people know that the federal government can tax a portion of your Social Security benefits if your income exceeds certain thresholds. That's a separate conversation we'll touch on later. But here's something that surprises a lot of retirees. For years, many US states were also taxing Social Security benefits on top of what the federal government was already taking. The good news: that's been changing rapidly. As of 2026, the vast majority of states, we're talking more than 40 of them, either never taxed Social Security benefits to begin with or have now fully eliminated that tax. Several more states have recently phased it out or offer significant exemptions based on your income. Only a small handful of states still impose any meaningful tax on Social Security income, and even in those states, there are often exemptions for lower and middle-income retirees. Now, I won't list every state here, because these laws are changing frequently, and what's true in your state today might be different by the time you watch this. What I want you to do is take action. Look up your specific state's tax rules for Social Security income, or better yet, ask a local tax professional. Let me give you an example. Meet Barbara. She's 69 years old and lives in Missouri. For years, she assumed her Social Security was being taxed by her state, so she just accepted it as part of life. Then her daughter helped her look it up and discovered that Missouri had recently eliminated its state tax on Social Security benefits. Barbara had been filing correctly, but she hadn't realized that going forward, she'd owe nothing to Missouri on that income at all. That's money staying in her pocket every single year, just because she took the time to check. So the question for you is simple: when did you last verify whether your state taxes Social Security benefits? If the answer is "I'm not sure," that's your homework after this video. Here's something that genuinely shocks most people when I tell them this. One of the biggest tax breaks available to seniors in America isn't advertised. It's not on a government flyer. It's buried quietly in the tax code. And it's worth hundreds, sometimes thousands of dollars. It's coming up next. Let's talk about the standard deduction. If you're not sure what that is, here's the simple version. Every year when you file your federal tax return, you get to subtract a certain amount from your income before the IRS calculates what you owe. The more you can deduct, the lower your taxable income. The lower your taxable income, the less tax you pay. For 2026, the standard deduction for most single filers is $15,000. For married couples filing jointly, it's $30,000. Those are the base numbers. But here's where it gets better for seniors. If you are 65 or older, and this is in the actual federal tax code, you get an additional deduction on top of that base amount. In 2026, that extra deduction is $2,000 for single filers and $1,600 for each spouse who is 65 or older in a married filing jointly situation. That means a single person, each 65 or older, can deduct up to $17,000 from their income before the IRS applies a single tax rate to it. A married couple, where both spouses are 65 or older, can deduct $33,200. Now, meet Robert. He's 71, widowed, and files as a single taxpayer. His total income, between Social Security, a small pension, and some savings interest, comes to about $38,000, with the age-enhanced standard deduction of $17,000. His taxable income drops significantly. In fact, after applying just this one deduction, his federal tax bill is a fraction of what it would be for a younger person with the same income. Here's the critical question. Are you or your tax preparer actually applying this enhanced deduction? In most cases, if you're using tax software or a professional, this is handled automatically, but it's absolutely worth confirming. And for those of you who are still itemizing deductions, meaning you list out your mortgage interest, charitable contributions, and so on, you'll want to compare that total against your standard deduction to see which one gives you the bigger benefit. For many retirees, especially those who've paid off their homes, the standard deduction wins. I get a lot of comments from seniors saying that property taxes are one of their biggest financial stresses in retirement. You own your home outright, or close to it, but that annual tax bill keeps climbing. For people on a fixed income, it can feel relentless. Here's something I want every homeowner watching this to hear clearly. Most states in America offer some form of property tax relief specifically for older adults. This can take several forms. Some states offer a flat dollar exemption, meaning they simply reduce the assessed value of your home before calculating your tax. Others offer a senior freeze, which locks your property value assessments at a certain level so it can't keep rising with the market. Some programs actually defer your property taxes until the home is sold, and a number of states and counties offer outright reductions for seniors who meet certain income thresholds. The eligibility rules vary enormously. Some programs kick in at age 62. Others require you to be 65 or older. Income limits differ by location. And here's the part that frustrates me on your behalf. In most cases, these programs are not automatic. You have to apply for them. Meet Dorothy. She's 74, lives in the same home owned for 28 years, in a mid-sized city in Texas. She had no idea her county offered a homestead exemption specifically for seniors over 65 that could reduce her school district taxes significantly. Her neighbor mentioned it at a block party. Dorothy filed the application the following week, and she's been saving hundreds of dollars a year ever since. The lesson there isn't complicated. Call your county assessor's office, look up your city or county website, search for senior property tax exemption, plus your county and state. You may find real money waiting for you. This is one of those areas where I genuinely encourage you to drop a comment below with your state. Not just for me, but because other seniors in your state might see it and learn something they didn't know. That kind of community sharing is more valuable than you'd think. All right, we're halfway through, and I want to ask you something. How many of these first 3 points did you already know about? Be honest with yourself. Because what's coming in the next 2 sections, most people have never heard of either one. Stick around. This one confuses a lot of people. So let me start from the beginning. Up to 85% of your Social Security benefits can be subject to federal income tax depending on what the IRS calls your combined income, which is basically your adjusted gross income plus any non-taxable interest plus half of your Social Security benefits. For single filers in 2026, if that combined income is below $25,000, none of your Social Security is federally taxed. between $25,000 and $34,000, up to 50% may be taxable. Above $34,000, up to 85% may be taxable. For married couples filing jointly, those thresholds are $32,000 and $44,000 respectively. Now, many retirees choose to have taxes withheld directly from their Social Security payments throughout the year. That's done using a form called the W-4V, the Voluntary Withholding Request. You can choose to have 7, 10, 12, or 22% withheld automatically. This is a completely reasonable strategy to avoid a surprise tax bill in April. However, here's the problem. If your income changed, maybe you stopped working, you reduced your retirement account withdrawals, you had a major medical expense, or your financial situation shifted in any significant way, you might be withholding more than you need to. Over-withholding means you're essentially giving the government an interest-free loan of your own money every month. Meet Gerald. He's 68, when he first retired, and was drawing from his 401k heavily. He set his W-4V withholding at 22%. 2 years later, he stopped taking those big 401k withdrawals. His total income dropped considerably, but he never updated his withholding. He was still sending 22% of his Social Security to the IRS every month, and getting a big refund every spring that he'd been thinking of as a bonus. It wasn't a bonus. It was his own money, returned late, with no interest. After talking to his accountant, he reduced his withholding to 10% and started keeping more of his monthly income where it belongs, in his bank account. The fix is simple. You submit a new Form W-4V to your local Social Security office. You can download it at ssa.gov. But before you adjust your withholding in either direction, please talk to a tax professional who can look at your full income picture. Withholding too little could result in a penalty at tax time. The goal is to get it right, not too high, not too low. This last one is one of the most overlooked, most misunderstood, and, for the people it affects, most impactful items on this entire list. It's called IRMAA, IRMRA. It stands for Income-Related Monthly Adjustment Amount. Here's what it means in plain English. Medicare Part B and Part D, the parts covering doctors and prescriptions, charge premiums based on your income. Most Medicare beneficiaries pay the standard premium. But if your income is above certain thresholds, you pay more. Sometimes significantly more. That extra charge is IRMAA. In 2026, the standard Medicare Part B premium is around $185 per month. But if your income from 2 years ago, because Medicare looks at your tax return from 2 years prior, was above a certain threshold, you could be paying anywhere from $259 to over $628 per month instead. For couples, this affects both spouses individually. That's a big number. Now here's the part that matters for people going through a major life change. Medicare uses your tax return from 2 years ago to set your current premium. But what if 2 years ago, you were still working and earning a high salary, and now you're fully retired with a much lower income? What if you recently divorced, lost a spouse, or experienced a significant reduction in income? There is an appeal process. It's called Form SSA-44, the Medicare Income-Related Monthly Adjustment Amount, Life-Changing Event Form. You submit it to the Social Security Administration and request that they use a more recent year's income, or your estimated current income, instead of that older tax return. Qualifying life-changing events include retirement, a significant reduction in work hours, the death of a spouse, divorce, loss of certain income-producing property, and a few others. Meet Patricia. She retired at 66 after 35 years as a hospital administrator. Her final working year, she earned $165,000. 2 years later, Medicare used that income to calculate her Part B premium, placing her at a much higher tier. But she was now living on Social Security and a modest pension, earning a fraction of that. She filed Form SSA-44, documented her retirement as a qualifying life event, and had her premium adjusted to the standard rate. She saved over $800 per year. Now, not everyone will qualify, and the process requires documentation, proof of the life event, estimates or records of your new income level, and sometimes additional paperwork. But if you've experienced a major income drop recently, this is absolutely worth looking into. You can find Form SSA, IDVS 44 at ssa.gov, and I'd recommend calling the SSA at 1-800-77-1213 or visiting your local SSA office to walk through it with a representative. Before we wrap up, I want to ask you something directly. Of these 5 areas, which one surprised you the most? Tell me in the comments. I'll read them, and your feedback genuinely helps me know what to cover next. Alright, let's bring it all together. We covered 5 tax areas where American seniors may be able to reduce what they pay or stop paying altogether in 2026. First, we talked about state taxes on Social Security benefits. Most states no longer tax Social Security income, but you need to verify your specific state's current rules because they vary and they keep changing. Second, we covered the enhanced federal standard deduction for taxpayers age 65 and older. In 2026, that extra amount can reduce your taxable income meaningfully, and it's worth confirming you or your preparer is applying it correctly. Third, we looked at property tax exemptions, freezes, and relief programs for seniors. These exist in most states and counties, but are rarely automatic. You typically have to apply, and most people simply don't know to ask. Qualifying life-changing events include retirement, a significant reduction in work hours, the death of a spouse, divorce, loss of certain income-producing property, and a few others. Meet Patricia. She retired at 66 after 35 years as a hospital administrator. Her final working year, she earned $165,000. 2 years later, Medicare used that income to calculate her Part B premium, placing her at a much higher tier. But she was now living on Social Security and a modest pension, earning a fraction of that. She filed Form SSA 44, documented her retirement as a qualifying life event, and had her premium adjusted to the standard rate. She saved over $800 per year. Now, not everyone will qualify, and the process requires documentation, proof of the life event, estimates or records of your new income level, and sometimes additional paperwork. But if you've experienced a major income drop recently, this is absolutely worth looking into. You can find Form SSA, IDVS 44 at ssa.gov, and I'd recommend calling the SSA at 1-800-77-1213 or visiting your local SSA office to walk through it with a representative. Before we wrap up, I want to ask you something directly. Of these 5 areas, which one surprised you the most? Tell me in the comments. I'll read them, and your feedback genuinely helps me know what to cover next. Alright, let's bring it all together. We covered 5 tax areas where American seniors may be able to reduce what they pay or stop paying altogether in 2026. First, we talked about state taxes on Social Security benefits. Most states no longer tax Social Security income, but you need to verify your specific state's current rules because they vary and they keep changing. Second, we covered the enhanced federal standard deduction for taxpayers age 65 and older. In 2026, that extra amount can reduce your taxable income meaningfully, and it's worth confirming you or your preparer is applying it correctly. Third, we looked at property tax exemptions, freezes, and relief programs for seniors. These exist in most states and counties, but are rarely automatic. You typically have to apply, and most people simply don't know to ask.